If you look at some of the meme coins that are going nuts, the speculation that's going on in a lot of the crypto sphere, it does seem like the floodgates are opening. But the price action on Bitcoin, while a little bit of a pop today, it's not enormous. It's taking us back to levels we were just at 2 days ago. And I would dare say that we're still stuck in this trading range of around 30,500 to 27,000. And the other thing I would say is that leading into the potential default for the U.S. government, this is when Bitcoin needs to shine, right? We saw it shine or start to shine with the banking crisis. The potential for a default should be seeing even more price action to the upside. So these are the things I watch as a technical trader. Is if we're not getting a bigger move later this month in Bitcoin, I would start to get very, very bearish.
Popular technical analyst and chief market strategist at Verified Investing and InTheMoneyStocks.com, Gareth Soloway says he is beginning to get even more worried and bearish about Bitcoin and the overall digital assets market, especially as a result of the hostile regulatory environment in the United States. According to the renowned trader and analyst, the crypto market is still very much in a bear market, and the minor price gains are only bear market rallies. As he has stated in previous interviews and video broadcasts, Soloway expects Bitcoin to drop to a new record low, lower than the $15,700 FTX bottom. He has had these gloomy predictions since late 2021 and early 2022 when he first predicted that Bitcoin would drop to the sub-20s. As a technical analyst, Soloway believes a bear market bottom can only be called when everyone has lost complete faith in the crypto market and sentiments are extremely low. According to the veteran trader and analyst, that has yet to happen to the crypto market in this cycle. During a recent interview with Stansberry Research, Soloway gives the example of the frog-themed meme coin Peep, which had a 1,500% surge in just 2 weeks. Soloway says if there's still so much speculation in the market for a meme coin, the crypto market has yet to hit the real bottom for this cycle. Another reason Soloway is holding off on bullish sentiments for the crypto market is the increasing regulatory hostility in the United States. Even with prominent industry figures like Coinbase chief executive Brian Armstrong urging U.S. regulators to give the industry some much-needed regulatory clarity or risk exchanges like his moving out of the United States, it is clear that regulators have a different goal in mind. According to Gareth Soloway, no regulation will be forthcoming until regulators hit their goal of having the industry completely under their control. He adds that they would achieve that with one important tool they are about ready to unveil. Before we listen to another one of Soloway's masterclass analyses, please take a little time to like this video, subscribe to the channel, and turn on post notifications so you never miss any of our subsequent videos. You can also help this video reach more viewers by dropping your comments and observations in the comments section below. So don't forget to do that as you listen to Soloway's detailed analysis. Thanks and enjoy the video.
A couple different things, right? And you're right. Here's the chart. We have that trend line that I had in last time we discussed it, right at that 30,500 level. We pierced it briefly a couple times and then came right back in. And we've really gone into this sleeper mode. If you go back to, mid-March, we're still sideways in this 27 to 30,000 range. So to me, this is a level that is still reminiscent of a bear market rally. If we get above, like I said last time, above that 30,500 level, we can start to talk about maybe the low was 15.7, but as of now, I don't see that, and I still see speculation. I mean, in trading markets, including commodities and cryptocurrencies and stocks and everything else, bottoms are made when there's massive amounts of fear, and people are very skeptical initially when something takes off. With Bitcoin, it hasn't been like that. We've seen the speculation in Pepe coin and all these other meme coins. It's a casino. And that's not the sign of a bottom. In addition, I look at what's going on with the government regulation. The government's purposely holding back regulation until they launch their CBDC, which then brings into the question of, is Tether even worthwhile anymore? Is USDC, is that even worthwhile if you have a CBDC that's basically fulfilling that job? Right. Does that have an impact on the cryptocurrencies as well? And I think it's important for investors to understand what's really going on here with the U.S. government. The U.S. government is following the Chinese playbook. Now, the Chinese, what did they do? They banned Bitcoin. And they said, okay, let's launch a CBDC, the digital yuan. And they had to ban Bitcoin because they didn't want the competition for the CBDC. They wanted the digital yuan to gain traction and start to be used as a currency, which it is now. It's being intercontinental. We're seeing trade with China being conducted with many countries with the digital yuan, right? So that was their playbook. And now look at what China's doing. China's actually saying, okay, well, now we'll allow people to be involved in Bitcoin again because we have our foothold via the digital yuan. The US isn't about to ban Bitcoin, right? That's not going to happen here. But how are they doing it? They're doing it in a different way. They're not allowing regulation. They're not giving any guidance on regulation. We know, is it a security? Is it not a security? Even Coinbase, right? Coinbase has said, hey, we may have to leave the US. They're suing the SEC to get clarity, and the government's just like, nope, we're not going to give you clarity. So this is the way the U.S. government is handling it until they launch their CBDC. So I'm in the full part now. Until we get a CBDC from the Federal Reserve, I don't think you're going to get regulation in the crypto markets in the United States. I actually have a very bearish outlook for the second half of this year. I'm actually looking at a correction of as much as 20% in the S&P 500. The charts are telling us this too. I mean, if we just look purely at the S&P 500, in fact, let's go right to that chart right now. What we see is a chart that had a big drop following the 2021 highs in in January of 2022. We saw the big drop. We've then seen complacency take hold. And this is really important for investors to understand. This is the way tops are made. You have this euphoria, which we saw in 2021 in all markets, including stocks and cryptocurrencies. You then have a dip, and then you have sideways consolidation. In fact, let me see if you would just let me bring up this chart of the NASDAQ composite. I want to show you this because I think this is a game-changing chart, and I'm going to put two side by side here. So here on one side, let me bring up the NASDAQ as well. We're going to look at the NASDAQ in two charts. All right, we're going to bring up the weekly chart here and the weekly chart here as well. And what I want to do on this weekly chart, going all the way back, we're going to go all the way back to the 2000 market when the dot-com bubble hit. Okay, now what we see here, look at this. This is just, by the way, Danielle, this is the stuff I live for, right? So what we saw was this down move off of the euphoria, right? We all agree that the dot-com bubble was euphoria. We then had the down move, and then look at the pattern that happened before the bigger move down occurred. And then if we go here, we look at the same sort of pattern formation, right? And so my thesis is that this is just the beginning of a bear market that we are entering in. And if we look at what the NASDAQ did, we know, first of all, the NASDAQ didn't make highs for 10 to 15 years. In fact, I think it was even 16 years. I actually think we're in the same position here where we've had so much bloat due to Federal Reserve printing of money that when this starts to drop, we're going to see the NASDAQ not make highs for probably at least 10 years going forward. But again, the mirror images on the charts are scary here in terms of the 2000 period and what we're currently seeing.
According to Soloway, speculation is as high in the stock market as in the crypto market. He expects at least a 20% drop in the S&P 500, adding that if the crypto market is still correlated with the top index, we could see a similar drop in Bitcoin and other cryptocurrencies. Soloway is not the only analyst predicting a gloomy decade for the stock market. Everyone from Real Vision chief executive Raoul Pal and macro analyst Lynn Alden has shared similar predictions that the stock market will not make new highs for another 10 years. Soloway, Alden, and Powell also postulated that the stock market going into a slump could spur new highs for Bitcoin and other cryptocurrencies as investors exit equities in large numbers. Of course, everything ties back to the economy and the Federal Reserve's next moves concerning inflation, money printing, and rate hikes. According to Gareth Soloway, inflation has become sticky and could stay above the Fed's 2% target for a few more years. This would mean interest rates stay up and no money printing for a market that has become completely dependent on the Fed's reckless generosity. Let's get back to Soloway's interview as he discusses sticky inflation and investor psychology in a market facing the potential end of an elongated bull cycle.
If you look at, first of all, the cycles, you have a cycle here where we're due for a corrective move. It's been an elongated bull market if you go back to 2009. It's all due to Federal Reserve printing of money and low interest rate policy, essentially they were just dropping money left and right, free money and printing money. The government was sending out checks. And then you look at what's happening now. Yes, inflation, we saw the CPI data come in a little bit, but it's not going to get back to 2%. It's just there's too many issues. The first drop from 9.5% to where we are now at 4.9, that's the easy amount. That's the easy drop. That was supply chain. The problem is wages have gone up. and it becomes very sticky. Once those wages go up, it's very hard to get that genie back in the bottle. So you're looking at inflation that probably stays at 3% for multiple years, and that essentially handcuffs the Federal Reserve. The Federal Reserve is going to be very, very careful and wary of printing money or lowering interest rates with inflation, let's say at 3 or 3.5%, because they're going to worry it's going to be a big pop to 15% as the next result. So without printing of money, this market has not been a real market for a long period of time. And when the investing public realizes that the Fed's not going to come to the rescue, that's when you see real panic set in.
But they've come to the rescue of the banks.
Yes, but again, yes, and you're correct on that. But the key is here is that when you see the rescues for the banks, that's not inflationary, right? They're basically making sure the banks aren't blowing up. They're making sure depositors are made whole, but they're not printing money. In fact, you could argue that what's going on with the banks is actually the banks are tightening credit. The banks are being more careful on lending, which is actually working to tighten monetary policy via the banks. So it's interesting, you're right, that they have come to the rescue of banks, but it's actually worked towards tightening versus loosening policy. Right now, let's call a spade a spade. The retail investor is still in the mindset that the Federal Reserve will come to the rescue. All right. So again, we've been conditioned. It's almost like ringing a bell and the dog comes to the food.
Yeah.
The same thing is true for investors. Investors have been conditioned since 2009 that the Federal Reserve, any sort of big hiccup in the economy, the Fed will come out and print money. And so what we see buy the dip continuing. We see it in crypto, we see it in stocks out there, and that's creating this false sense of security, or what I call complacency. At some point, that kind of mindset of the investor will shift dramatically. So again, to me, that's where the market has a lot of issues in the future over the next 6 to 12 months.
There is a lot to unpack from the video, especially Soloway's postulation that regulators would only get to work after a central bank digital currency has been launched in the United States. That could be quite disastrous for the development of the industry in the U.S., as there is still a wall of bureaucracy to be pulled down before a CBDC is launched. The Federal Reserve issued its first paper on CBDCs in January 2022. According to the central bank, the paper titled Money and Payments, the U.S. dollar in the age of digital transformation was the first step in fostering a broad and transparent public dialogue about the potential benefits and risks of a U.S. CBDC. According to more recent information on the Fed's website, no decisions have been made about CBDC. In March, when Fed Chair Jerome Powell appeared before the House Financial Services Committee, he noted that issuing a CBDC is something the Federal Reserve would need congressional approval for. And whether it's just some empty politicking or real fear about the impact of a central bank-controlled digital currency, senators like Ted Cruz and many other Republican and Democrat lawmakers and politicians are not giving the green light. What are your thoughts on Gareth Soloway's interview? Do you think regulators would wait until the Fed issues a CBDC before they bring suitable regulations for the crypto industry, even when developers and investors look abroad for better regulatory environments? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications so you never miss any of our regular uploads. Thanks for watching.